In the previous video, we found that MC equals MR is the profit maximizing condition for any firm type that we'll talk about. Then in particular for perfect competitors, we can find that price equals MR because for any individual firm, ignoring the entire industry over here, for any individual firm, if they want to sell another unit of output, they can do so at the market price. So the marginal revenue from selling their next unit of output will always be price. Right, from this and our optimal profit condition, we can find P equals MC. So let's take a look at how this works in the short run for a perfectly competitive producer. Right, we know that we have here our price, all right, price equals marginal revenue, and that for a producer, the optimal quantity is going to be MC equals MR, or for the perfect competitor, that means MC equals price. So we've got our marginal cost curve up here to where MC equals price, MC equals MR. And this is a little bit more U-shaped. Usually we don't have 2 points of intersection. We think of it as being a little bit more Nike swoosh shape. So starting down here and coming up. Anyway, so here's our profit maximizing MC equals MR at point A, and our profit maximizing quantity of 8. Right, so how do we know that this is profit maximizing? So again, remember profit is equal to total revenue minus total cost, right? So what would happen if this producer produced a quantity lower than 8? What about quantity equals 7? Well, the marginal revenue of ones in here, the 7th to 8th unit, are price. And how much does it cost? Ignoring fixed cost, average variable cost, but it's even above average total cost, which means that the next unit, if we're producing 7, the next unit, the revenue we get from the unit exceeds the cost of that unit. So we're leaving some profit on the table. There's some lost profit. And likewise, if we produce too much, we produce a Q greater than Q star of 8, the marginal cost, the cost of the next unit, is going to be greater than our revenue. Right? So here, if we produce too little, revenue of the next one is greater than cost. We could profit by making that unit. Out here, the marginal revenue of the next unit is less than the marginal cost. So we would be losing money producing that 9th unit and losing profit. All right, so P equals MC. Here's our price. Here's marginal cost. We find the intersection. All right, any point where P is not equal to MC is not profit maximizing. So now we're going to talk about the firm's production decision in the short run, which is to produce a positive quantity or to shut down, meaning produce a quantity equals 0 in the short run. I find sometimes this is easier with numeric examples, so I've posted a note set that contains some numeric examples. I'll go through some numeric examples in a separate video here. But in the short run, what we can say is that ultimately the firm's shutdown decision will be comparing average variable cost to price. Right? If average variable cost is greater than price, the firm should shut down. If average variable cost is lower than price, the firm should stay open. Right, again, I'll show a mathematical example of why this is the case. We know that profit, positive or negative, is going to be determined by average total cost versus price. So in this case, let's find the profit maximizing point. Here's MR, Here's MC, so our profit maximizing point is A at quantity of Q star. Marginal revenue at this point, the price is less than average total cost, so we're going to be losing money. But does that mean we should produce a quantity of 0 or shut down? It turns out no, the comparison is going to be with average variable cost. So in the numeric examples, we'll kind of prove that that's the case using numbers. I think that's the easiest way to see it. Make sure you take a look at the example problems and then the notes that I posted with examples, which is going to be helpful. All right, so in summary, we can figure out if the firm is making a profit, positive profit, or a loss from the average total cost curve. But we as economists are going to consider fixed cost as sunk and look only as average variable costs. We've already paid for the cost of the factory, so we're going to ignore that fixed cost, and we have these variable costs to continue producing. As long as the price, what we get, is higher than the average variable cost, the next unit, we'll continue producing. So the firm's short-run production decision, produce a positive quantity or not, produce 0, is going to be price compared to average variable cost. As long as average variable cost is, as long as price is above average variable cost, so up in here, the firm will produce positive quantity, right? What we're saying here, MR equals MC. At this point, we're above average variable cost. So this could be saying that the next unit, the price is say $4 like before. And if we produce that next unit, the variable cost, ignoring the fixed costs of production, the factory we built, the next unit will cost say $3 to produce. So we should do that even though the fixed cost of our factory included puts us at producing at a loss. All right, again, I think this is easiest to see with numeric examples, so take a look at those. So what we've just done is derive the firm's short-run supply curve. All right. We know that the firm will produce a positive quantity or not shut down only if price is above average variable cost. And we also know that the firm is going to produce MC equals MR, or in other words, MC equals price. So for any possible price above average variable cost, we can trace out the marginal cost curve, and that intersection with price would be the quantity supplied for the firm, or in other words, the supply curve for the perfect competitor is marginal cost, which is above average variable cost. Right? Why is that? Okay, here's price equals average variable cost. If our price is below that, we produce nothing. So there's no supply. If price is above average variable cost, we produce a positive quantity. In particular, we produce MC equals MR, or P equals MR, P equals MC, all equal in this case. So P equals MC is going to be all of the points along this marginal cost curve. All right, so what we can say in the short run, the competitive firm's short run supply is marginal cost above the point where P equals AVC. Right, what happens if we have, say, changes of input prices? Changes of input prices are going to increase marginal cost. Right, what does that look like? There's our supply shift. Increase input prices in this case, our marginal cost goes up. This is a supply shift to the left or a supply decrease. All right, so finally some topics that I'm not really going to cover here in this video. I'm happy to make a video about it if people want to, but we'll talk about short-run market supply, and we treat that exactly the same as short-run market demand. You're just going to sum up all of the quantities supplied. So I have an example of that out there. Hopefully that's kind of familiar to you from market demand. And then we also have this idea of producer surplus. right? If we use the entire marginal cost curve looking like this, our producer surplus is the area above marginal cost and below price. But for our cases, we're going to be using the triangle formula. Even this is curved, but we'll be calculating producer surplus using the area of a triangle, and that's going to be really similar to consumer surplus, right? You've got a price, you need a supply equation in slope-intercept form, which we just related to marginal cost on how to derive supply. Once you have the intercept, right, you can do price minus your intercept times quantity and get producer surplus. So hopefully that's a familiar topic. If you have any questions on that, let me know. I have a couple example problems out there.